Hello everyone, I'm Steve Savant, host of the Business Insurance Zone. Today and all this week we're talking about tax-free income using life insurance, part of our series on tax-advantaged income. A non MEC life insurance contract can be designed on 4 different mortality chassis depending upon the client's risk tolerance and their commitment to annual premiums. And with me today and all this week to sort it all out is our special guest, Eric Palmer, National Director of Advanced Sales for Brokers Alliance. Eric and I are going to escort you through the various mortality chassis, the risk tolerance issues, and we're going to address the policy design tactics taken from the best proposal illustrators in the country. And remember, before moving forward with any of the strategies on the show, always seek approval from your CPA, your attorney, and if you're security licensed, always check in with your broker-dealer compliance department. Well, welcome everyone. I'm Steve Savant, the whiz of the biz, and with me today is Eric Palmer, National Director of Advanced Sales here at Brokers Alliance. How you doing, Eric?
Doing well.
We're broadcasting live from Fountain Hills, Arizona, home of America's largest fountain, to a nationwide audience of financial professionals and advisors. And remember that the Business Insurance Zone is a Bravo broadcast initiative from the National Insurance Clearinghouse, the marketing arm of Brokers Alliance. And we distribute in wonderful resolution, HD 1080p, all over the web on YouTube, Vimeo, Facebook, Twitter, and LinkedIn. And of course, our on-demand section, video section on brokersalliance.com. Our show's email address, if you want to write us, thebiz@brokersalliance.com, or you can call 1-800-290-7226, extension 147, on any quotes or questions you may have on life insurance, annuities, DI, LTC, and group pension plans. And remember, we're actually recording in November, and November is LTC Annuity Month or Awareness Month. And so if you're thinking about long-term care, whether it's a standalone policy, whether it's a linked benefit to annuities or a linked benefit to life insurance, this is a kind of a month, because I've been tweeting and blogging on this. There's a lot of awareness out on our industrial sites, and even I've seen some commercialism for retail clients.
Well, and something else too, since kind of in the spirit of income and taxation, and I think we'll talk about a little bit more on our Friday show, but the Pension Protection Act, if you don't know it, you don't understand it, give us a call, because we've got great supporting materials. But you can leverage the Pension Protection Act to take tax-free distribution for long-term care, and you know, the application of that alone is huge in this market. It's part of the overall equation. It's something you need to be talking about, and it opens up a huge market for you if you're in the senior market already. That's right.
So don't forget to call us on that, because that's a huge issue right now in the awareness. People understand it, so they're hip to it. But today, no LTC. We're showing our tender loving care TLC for our mortality chassis. Now, remember, you don't have to be a purist like I am. I'm into, is it an indemnification scenario? Is it an income scenario? If it's an income scenario, like we're talking all this week, I'm looking at 4 different chassis: whole life, current assumption universal life, indexed universal life, and variable universal life. Now, this is so weird to talk the way I'm going to be speaking today, but the person says, well, which one should I do? And I say, I have to do a client risk tolerance kind of a test first. And I have several, and we do too. You can call us at 1-800-290-7226, extension 147, and say, Steve, send me one of those risk tolerance maps. It's really good. You can walk your client through it. It will measure and give you a little idea. Is your client aggressive? Are they moderate? Are they conservative? It'll map it all out. Once you've determined that, I can kind of tell you where you want to play.
Well, it's interesting. You don't usually think about doing a risk tolerance tests when you're talking about life insurance, but it's actually a big part of the equation there, because if your client's not adverse to any sort of risk, then showing them indexed or variable policies could cause problems down the road if they see that they're getting negative returns or lack of return overall. You know, they might want to get out of the, you know, before they give it enough time to mature and produce what your overall plan is doing. So if in 3 years your clients are telling you they want out, then you didn't do the test up front, you didn't accomplish the overall goal.
Well, when I think about it, the argument's always going to be not so much with current assumption UL or whole life, participating whole life, and there's a couple of ones out there that we really like, believe it or not. But the argument's always going to be between variable universal life and index. Now, most of the index, and correct me if I'm wrong, I think that the leading carrier's cap is 17%.
Right.
I think that's the cap.
That's about it.
Now, the downside is, right, nothing except for your expenses of the policy. I mean, you're not going to get credit negative if you use indexing.
Right.
So the cap is there. Now, if I use VUL, I don't have any cap, but I also don't have any downside protection either.
Right.
Now, some people who believe that over the long haul of the contract, and talk about how things have changed. We just saw a carrier we were interviewing with whose actual VUL expenses, I can't believe I'm saying this,
right,
are actually lower than their indexed universal life. I was in shock.
And we challenged them to that. We analyze a lot of products. So when we were really analyzing the cost structure, we were proven wrong that there is an opportunity for a VUL to be less. But again, you have to analyze that risk. Is the client willing to see negative returns or low 2% S&P annual point-to-point returns for a couple of years in a row and stick with the product, because the upside potential is very significant in those two types of products.
I'm thinking, the beta risk for 17%, forget indexing for a second, just say, if I'm shooting for a 17% return, what's the Morningstar beta risk on any fund that has that kind of aggressive posture?
Right.
Even if you elongate the investment and say you got to stay in for 10 years, let's say a decade,
right?
I'm looking at it. Well, it's more than zero.
It is.
So it's going to be someplace 1 plus whatever. I'm sure I'm short on this. So when I'm looking at beta risk, I'm thinking if I got 17% on an index and I didn't lose any of my principal, I might be okay with that. I think that's a good number.
Well, the cost for capping out your return is that not only just the protection, but also the deferral. The power of compounding interest. We talk about it all the time. We talk about it a lot in our annuity shows. If I got a 17% in a life insurance contract and I got a 17% in a fund account or an investment account of some type, what the actual return, compounded return on my money was more effective in the life insurance contract. So the tax issues and all those other issues start to come into play and drop that return down.
If I'm kind of a conservative investor, I'm going to be looking at the two mortality chassis that are somewhat conservative and driven by interest rate market. So I'm going to be looking at participating whole life. I'm going to be looking at current assumption universal life.
Right.
Okay, those are my two players. Oddly enough, at the time that we recorded this show, most of the participating whole life carriers have already declared their rates. Most of the rates or the dividends went down.
Right.
Heads up. Mass Mutual, shock. Mass Mutual went up.
Is that right?
I'm shocked. And they already had the leading 10 pay, 20 pay, and like to 65 income scenarios with their whole life. They already were the leader. So with some of their counterparts going down in their declaration on their dividend, right for 2012, they actually went up because of their investment postures. They actually did a pretty good job.
And we're talking under 6% for a lot of those major leaders in the whole life marketplace. Now they're averaging anywhere between 580 and 600 basis points. So, with that type of dividend return, you start to question whether or not you can afford to do an income scenario with a whole life contract now.
Now, remember, heads up, dividends are not guaranteed.
Right.
It's a return of unused premium.
Right.
And none of our, indexing isn't guaranteed. Some have floors that give you a 1% guaranteed, some up to 3%.
Right.
Okay. But when I'm looking at if I'm a conservative investor, I'm either looking at participation whole life or I'm looking at a current assumption universal life contract. Those are my really two players in interest. And they each have differing issues. And when we get to Friday's show, we're going to talk about loans, because then it could make a difference there.
It could, and they have a little bit of different cost structure. So when we see current assumption products right now in about 4.5, 4.75 in terms of a rate, remember again, we're at the first week here of November, so that rate could change significantly by the end of the year. But that's about where we're seeing these current assumption products. And like I said earlier, the dividend being around 6%, don't just assume the whole life's going to be the winner there, because when you take down the cost structure of those contracts, it's the spread that's really attributed to the actual cash value accumulation. And we see a lot of strong current assumption products out there because they're designed on that UL chassis, which is a little cheaper than the whole life.
Now remember, and again, I'm not trying to wave the flag of participating whole life here. It is what it is. When you start illustrating, and we've been illustrators for a long time, when you start designing and illustrating proposals, and you start to go below 7% in your illustrations because you're trying to be reasonable for the client, some of these and the one I used as an example, Mass Mutual, they're going to be players.
Right.
They're going to be definite players. So when I'm looking at them side by side, I'm going to have to determine, well, the risk is similar, but here's what I'm getting. Now remember, could I say that I'm going to get 7% with indexing? No. Could I say my dividend is going to be there? No. I mean, have they ever not paid a dividend? I don't know if they have it or not, or they missed their mark, but I can't guarantee it. I can't talk about that.
Right.
So from an income point of view, I'm looking at conservative posture. I'm looking at current assumption UL, interest rate driven, dividend driven by whole life par whole life interest rate. That's kind of conservative. Again, could you lose on a current set? Well, you could default to the guaranteed mortality charges and the guaranteed crediting rate, and which are awesomely high. Now, just a little heads up on that too. I've never seen, to my knowledge, now there could be somebody out there, and so I disclaim that right away. I've never seen anybody drop to their guaranteed mortality yet.
No,
I mean, not to my knowledge.
Not to my knowledge.
I've seen them go to the guaranteed interest crediting rate, but not that.
Which is why quite often, if you want to stress test any policy, you take the current mortality charge. So you run your minimum guaranteed rate in your non-guaranteed column, and that's going to be a strong enough indication of a stress test that you can rely on whether or not that's going to be the barrier. Because unless we're talking about famine or major effects on mortality, we're not going to see too much of a pullback. However, I did have somebody tell me that generationally speaking, the generation behind the baby boomers are supposed to have a lower life expectancy than the baby boomer generation, which I don't know how much fact is put to that, but the lifestyles. Significant lifestyle.
Are you guys
difference.
going crazy?
I think we're using too much technology. I don't know, but it's not significant enough, I would assume, to make a difference. So you're comfortable and you're safe, I would say, taking a minimum guaranteed rate, running it in that non-guaranteed. So you take today's mortality charges, and that's going to give you a good depiction of how to break the policy or if it will break.
Yeah. So if your client is conservative, and they really are looking at something more interest rate driven, something they can get their hands around, because indexing, really, heads up, we've been teaching on this for a little while now. It's still difficult for a lot of our producers to understand what we're talking about. So this is a little bit easier to do. It's conservative. It's based on interest rates. If interest rates go up, current assumption UL is going to be great. If interest rates go up, the players that are really good, like the mass on the par whole life, they're going to go up. You're going to see numbers that are going to be reflective of that. Now, when I think about the next two chassis we're going to talk about after the break, when I think about those two chassis, it's a whole nother game there. And again, we want to make sure that everybody understands the risk issues involved, because that's how I choose my chassis going forward. And of course, we could have used index in our discussion, but I want to kind of save it for the second segment. When we come back, we're going to talk about all of this. You can view and download our white paper on this and the complete video series that we're talking about at www.maxretirementreport.com, as well as you can go out to our tax advantage series at www.brokersalliance.com/tax advantage products. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. When we come back from the break, we're going to talk about the other two chassis, variable and indexing. I just want to take a moment in between our segments. If you're looking for new ways to expand your practice, tax advantage income strategies could be a game changer for your business. With everyone projected to live longer and taxes expected to increase, tax advantaged income strategies for retirement will become the most important component for savers and investors. At Brokers Alliance, we've designed tax-advantaged income strategies using annuities and life insurance. From annuity income riders to medically underwritten SPIAs, from participating whole life to current assumption or indexed UL, we have the concepts consumers are looking for. These tax-advantaged income strategies may generate more net spendable money for your clients' pockets than conventional concepts currently shown by professional planners. You can view and download our white paper and the tax-free video series at www.maxretirementreport.com, as well as our tax-advantaged overall series at www.brokersalliance.com/tax-advantaged products. Tax-advantaged products. Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and interviewer extraordinaire. I'm with Eric Palmer. We've been talking about tax-free all this week, and in this segment, we're going to talk about IUL and VUL. And just a little side note, if you want to write us at the show, just write our email address, thebiz@brokersalliance.com, or call us toll-free, 1-800-290-7226, extension 147, for any quotes or questions you may have on life insurance, annuities, DI, long-term care, and group pension plans. And just before we get into it again, I'm going to talk about my caveat for tax-free. Just remember, a life insurance contract has to be designed as a non-modified endowment contract. the contract has to be kept in force for the life of the insured. If the maturity date of the contract does not contain a maturity date extension provision, the client should be notified in writing in the application and have the client initialize it. During distributions, any withdrawals of basis or policy loans of gain must comply with the foresought rule, the guideline annual, and the guideline single, and if you're using CVAT, the cash value accumulation test. Now, the reason I have to go through that is because when we're talking about tax-free money, income stream, supplemental income using life insurance, a lot of planets have to align to make that happen. And at Brokers Alliance, this is what we do for a living, 24/7. I mean, indemnification scenarios are what they are.
Right.
Here's the grid, here's the premium, who's got the best number for whatever for the coverage.
Right.
Indemnification, no problem for protection. But when we get into income, it's a totally different scenario, and we have to make sure everything we're talking about is correct on the actual illustration, so that I can go to the client and say, based on what you've told me and this caveat that I just read, I can deliver tax-free income, and my tax-free income will also not injure your Social Security benefit, which a lot of other income or investments can.
Right.
So, Eric, sorry about all that wordy knowledge there. Let's talk about it. We're into the second two chassis, variable universal life versus index. And it's not that I'm blowing off whole life variable, but really I don't think it's a player anymore, and nobody's selling it hardly at all.
Well, and something important to kind of keep in mind, and a good reason to kind of segment VUL and index UL together towards the end here is that it's not always just an income scenario. You know, we talk about indemnification, we talk about income, but sometimes it's a combination of both, especially with our more sophisticated clients. A lot of times if you're dealing in an affluent market, you're planning for both supplemental income and a little bit of coverage. There are some trusts that are out there. AXA Equitable is a company that actually produced some documents where they have a lifetime access trust for spouses that go in tune with some estate planning that would have income distribution. So those scenarios exist, and the hardest thing to do is provide income and still have that death benefit be what the client has in mind or what you're planning for. So those are it just adds another layer of moving parts to the scenario. And when you're using VUL or index, it's that much harder, and the client takes on that much more risk if death benefit's a part of the component that you're managing.
When I'm trying to measure my client's propensity for, his risk tolerance and his propensity to take a hit, what index brings to the table is it brings me a comfort zone, I guess I would say, a kind of a solace from an investor point of view, that I am not going to get credited any negative numbers to my principal. Now, heads up again, as we said in yesterday's show, you still have expenses to pay in the policy.
Right.
And I can't get away from that. And so if you actually were credited zero, you would actually go negative on your policy in that year with expense loads.
Right.
And when we get into Friday's show, we're going to talk about, hey, and it could be exacerbated if you were taking distributions and that occurred. I'll get into that Friday.
Right.
Now, when we're talking about the difference, though, between variable, I have upside potential. I'm not dealing in indices. I'm dealing in individual accounts. Although you could invest in an S&P, and they're very cheap on a variable chassis. What? Some of them are down to 20 basis points. It's ridiculous.
Right.
Costs you nothing on variable. But you have so many access to other funds and variable, and the upside potential to go. If it's a home run year, you could be experiencing it.
Right.
But if it's a terrible year like 2008-9 were, it could be terrible.
It could, and that could directly affect that principal account, which is related to the amount of death benefit that the policy itself can sustain. So you can have a lot of things go wrong there. Sometimes a combination of those two products makes a little bit of sense if your clients, they like the idea of a little bit of risk, but not completely for the whole picture. But where the IUL and the VUL, what I should say they bring to the table is the client that's still questioning whether or not they should be fully invested in the market, and they get the idea of life insurance. They see the benefit of especially the loan regime, being able to take a tax-free distribution, but they don't want to miss out.
Right.
And so that's why these products play such a crucial role in doing income planning.
I like it. If you were a conservative, like we said in the first segment, if you were a conservative, said, gee, I'm kind of conservative, so that's why I did my risk tolerance test. I did come out as a conservative. I don't really know if I can dip my toe in the water.
Right.
This would be probably the what I could say the least hassle of dipping your toe in the water if you wanted to use indexing. So if you want to graduate a little out of current assumption UL, I at least have a chance of making a little bit more than probably that. Remember, and this is and we're going to have Cheryl Moore on, the complete queen of this whole issue of indexing.
Right.
But when you think about it, these were designed and we're going to talk to Cheryl about this, indexing was designed to be about 200 basis points better than whatever the current assumption interest market is. So when you're sitting there, I have people showing me 9, 10%. Well, I hope it happens, right? And even if you have a look back that actually qualified for that, okay, fine, illustrate it. But I'm really looking, if the mark to mark on my interest rate's about 5, I'm going to show 7,
right?
Just because that's the designer. The designer had that in mind.
Sure. And if you look, a lot of times I hear the argument the last 20-year S&P is 8.25. There's a lot of different ways to kind of position this, but I don't count the last 20 years. I say that we need to start as if 2008 was day one, and we need to look forward because the markets are going to react very differently. If you want to look at market segments to compare those types of returns to, go back to the Great Depression. That'll give you a good indication of what a market will do outside of a recession. And so a lot of times, we need to think about these products in the way we illustrate them, not just based on the average rate of return showing 7% and living with that for our client. Because remember, your client's going to remember the numbers that you show them and the numbers that they're not getting at the end of the day 15 years from now. So take and go run those illustrations, run the VUL and run the index product year by year at least for the first 10 years and see how it affects cash value, and show your client what 3 years in a row will do to cash value, and then hit it with the full cap at 17% to show them how the policies are designed to recover from an interest rate, but also bear in mind the environment that we live in. I don't anticipate the S&P maxing out its caps year after year over the next 3 years. A lot of experts out there are saying, hey, 2 to 5%, we're going to be happy, and if that's really the case, then your client's not going to see what you showed them on that illustration. They're going to want to bail before they let the policy do what it was meant to do on a 10 or 15 year window.
And remember, we're just going to say this until we all believe it. We say it's a long haul investment.
It is.
And I like 15 years personally. I could go maybe 12. I could be talked into it. But I'm really looking at a solid 15 years that I want to be able to play on this, because I know then I'm going to get past the surrender charges. Some of my expense loads are going to drop off the planet. I want to be able to come to the place where I'm managing my costs. But now we're talking about today's show, managing the mortality chassis, selecting the right one for the right client based on risk tolerance and how long I'm going to hold it.
And that timeline is going to affect, the ability to take the best condition of a loan, from your policy as well. So a lot of times the spreads dropped off or will drop off after 10 years, and I think we'll address that more tomorrow's show. But the longer you wait, the better things get in terms of how the policy will deliver for the client. So if they're thinking 5 or 10 years, don't show them life insurance.
Right, I totally agree with that. Now, again, I'm not trying to make a negative or a positive on variable universal life. If you felt in your heart of hearts that the market could do a pretty good number day in and day out at 15. Now, remember, there's people out there on the radio on a national broadcast that's telling that he can do his asset allocation model knocks out 12% day in and day out.
Right.
I don't know why he says that. Maybe it's true, maybe it's not.
Right.
But if I thought I had 12% and I could knock that out day in and day out, and I could pound that number, and I wanted to use something like variable because almost all the index is probably, they're not at 17. The only one carrier I know of that's at 17 cap.
Right.
So
average is about 13.
Yeah, it's down. Right. So if I was down there, if I really thought, hey, I could exceed that with my variable, I have no problem. Long haul minded people, you understand the risk. Could you lose it? Yes, you could. And you could lose on a variable contract, and I could still have the expense loads I'd have to pay on it.
Right.
So it's a double whammy. And I hate to say it like this, and I'll get into this on Friday's show. What if you had a variable contract in a loser year during distribution? You'd have your loss of principal, you'd have your expense loads to pay, and I have to pay also a policy loan on top of that.
Right.
So, I mean, there's a charge for all this.
And there's a little bit of raw market exposure in those products. You talk about the national individual managing a 12% return portfolio. That's actively managed, daily managed. And some carriers will, on their variable contracts, and I will give them this credit, they will provide a more of an active managed type portfolio access, but at the end of the day, it's raw to the extent that you're directly related to that investment, and there's nobody out there watching your particular account that day if the market crashes, and so it's harder to prevent the loss or prevent the bleeding than if you were in, say, an index contract where you're more based on a year-to-year return or the overall performance over a set period of time, and you've got some boundaries, again, the floor being zero.
Well, when we think about it, again, I'm not trying to push one over the other. It's an issue of risk tolerance, it's an issue of hold position. It's a lot of things. But if you're a normal American, you said, hey, if the average in indexing was 13 or below, I don't know what that number is. If I was sitting around 12 or 13, and I said, well, I can probably get low double digit 10 to 12, I think I can live with that.
Right.
And that's why I keep going back to people, is that good enough? Now, I want to measure again, we talked about beta risk. My risk to lose principal is the quintessential question on variable. I know I have to pay expense loads on all contracts. I can't get away from that. But that's the one that I watch on variable. If I have a client that's used to buying mutual funds, who are used to showing I have risk in my portfolio, I have already been doing this in my asset allocation model, I'm much more comfortable. I don't like using VUL when I have a newbie in the market, a person who's just dipping their toe in, that they've never done really mutual funds, they're just starting their 401k.
Right.
I just don't know if that person's really a qualified person for variable contract.
Well,
like that.
the less your client understands the products you put them in, the more controversy you open yourself up to later on down the road. And you have to remember, there's not a single insurance company other than one with one variable product that will actively manage the client's expectations once they get to the point of income. So let's talk about the process. You've got to go through. You've got to take or determine whether or not you're taking a withdrawal basis or a loan. You've got to understand the loan type. You've got to have somebody get the ledgers together. There's a lot involved there, and nobody's doing that for your clients. So if they don't understand the product itself, that opens you up for more problems.
Yeah, we may have to start a whole new company just to do that issue alone.
Literally.
Because that's a huge issue.
Right.
Well, remember, you can view or download any of the shows we're talking about all this week, and of course our patented white paper on the tax issues at www.maxretirementreport.com, as well as the Tax Advantage 5 video series recorded last month at www.brokersalliance.com/tax advantaged products. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone. The Business Insurance Zone.
This has been a Bravo video event from the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.